Hello everyone and welcome back to the Energy Storage Digital series from Solar Media, and you're with the webinar The Future is Arbitrage, a deep dive into the merchant model. My name's Andy Colthorpe, I'm the editor at Energy-Storage.news. I'll briefly be your host at the beginning and some questions at the end. Firstly, I'd like to say a big thank you to our sponsors, Clean Horizon, EDF and NEC. And of course, this is part of the wider series organised by Solar Media, including this digital energy storage series taking place this week and with further strains to follow over the next coming weeks. See our full portfolio, visit solarmedia.co.uk. Now, some quick housekeeping notes before we get started with today's session, which is with Ben Irons from Habitat Energy. I would like to draw your attention to the special training session being run by Clean Horizon on Wednesday from 1 p.m. till 3 p.m. BST, so that's 2 till 4 European time, I believe. This will look at the main European regulations for energy storage and is essential for anyone trying to tap into the European markets. Also, don't forget to log into our Meet Me zone this week. You can use it to organise meetings with other participants, meet new partners and new suppliers and other stakeholders. Okay, so this is a pre-recorded session, so we won't be doing questions live from the audience, but I will have a few questions for Ben at the end of the session. So I'd just like to move on to the main part of today's session and welcome our speaker, Ben Irons. Ben is a co-founder of Habitat Energy, which is a trading and optimization service for grid-scale battery storage and other flexible assets in the UK and now Australia. Habitat Energy uses machine learning and advanced analytical techniques to underpin a fully algorithmic forecasting and trading strategy for day-ahead, intra-day, balancing mechanism markets and more, accessing value from both physical dispatch and financial trading. Ben has previously held roles as executive director and board member at Aurora Energy Research, where he founded and led the consulting practice, been strategy director at Centrica Energy and energy and sustainability consultant with McKinsey & Co. So Ben's talk, which he can elaborate more on, of course, will include topics like the role of algorithmic trading and how to make the investment case work for energy storage. So Ben, I'd like to pass it over to you.
Thank you, Andy, and thank you all for listening. I'm really glad to share some of our perspectives and views on where we're at with battery storage, particularly from an investability perspective. And the main message that I'd like to share with you today is things have changed really quite significantly in the last even 3 to 6 months. And our experience in the UK and increasingly in Australia is that merchant business models for large-scale battery storage have really come of age now and are seen as eminently investable, offering sufficient returns to justify the merchant nature of the investment case. Obviously, this has been a hot topic for some years now, but I'll try and explain in the course of this talk why it feels like times really have changed. And this marks somewhat of a turning point for grid-scale battery storage. So hopefully you can see the slides on the screen in front of you. Just to say a little bit more about Habitat and what we do before I go on to talk about the investment case and how it works. Habitat Energy we describe as an asset optimizer, a lot in common with an aggregator, although we tend not to use that word given that we're not really about bringing together small assets, but rather providing a bespoke optimization service for grid scale batteries, typically 50 megawatts and above. We've got full route to market capability in the UK and shortly in Australia. We also tend to get involved quite early in the development process for the projects that we ultimately operate, often playing an advisory role on topics like what duration of battery should our clients work with, what warranty is going to be suitable for the trading strategy we have in mind, what certainty can the investor get in the revenue that they should anticipate, those types of questions. We then, once operational, provide an interface between the physical asset, which is owned and maintained by the asset owner or other third parties, and we're trading that battery in wholesale markets in the UK, that's day ahead and intraday, as Andy said. Also the balancing mechanism, which can be done in 2 different ways. And we're also offering ancillary services, primarily frequency response, which at the moment, at least in the UK, is a very useful complement to the wholesale arbitrage trading activities. Our platform is called PowerIQ, and it's been up for a couple of years. We've been operating batteries full-time since the middle of last year. And our portfolio has grown quite considerably of late. We're now over 100 megawatt hours operational, and will soon be double that. Our clients publicly announced, and Gresham House among them, Arlington Energy, Pivot Power. As Andy said, our approach, because it's been built primarily for battery storage right from when we were founded about 3 years ago, we've developed capabilities and techniques that we think are best suited to that specific technology. And there are actually a number of things unique and quite challenging about optimizing battery storage that don't necessarily apply to other technologies, even flexible ones like gas peakers, for example. The nature of battery storage, given the short duration and the degradation and other features, means that machine learning and algorithmic approaches are just about essential to get the most value out of the asset. So here's what I would like to cover. I'll say a little bit about the investment case for battery storage and why I think it has come of age. And this will be fairly high level, so those of you familiar with battery storage may know most of what I say here. But then I'd like to get into a little bit more detail about how to make the investment case work. And this is a little bit more into the nitty-gritty. Some of the questions you might have struck if you've looked at building investment cases for battery storage. Some of the questions I get asked most often, and our house view on how to think about those issues. And at the end, I'll just touch briefly on another interesting and related topic, which is how does battery storage look when it's co-located with solar? So for any merchant battery storage investment, just talking in very general terms initially, investors are going to be looking for at least double-digit returns. So IRRs in the 10 to 12% range. This is unlevered pre-tax nominal IRRs that I'm talking about here. So if you're looking to build a battery storage asset, you'll operate for probably 10 to 12 years with the first set of cells before they're fully degraded and need to be replaced. Once they're replaced, you'll return the system to full nameplate capacity. You can then run through a second set of cells that's likely to take in the order of 20 to 25 years. And that's the investment horizon over which we typically model in order to produce those IRRs that I'm talking about. So if you work backwards and say, well, what kind of revenue do I need to be earning from the trading activities on storage in order to hit those IRRs? It turns out that the critical number is about 40 to 50,000 pounds per megawatt of battery storage capacity if it's a 1 hour system, so it's the same in megawatt hours in year one. And of course, that will naturally fade over time as the usable capacity of the cells degrades. But taking all of that into account, and we put some inflation in here as well, that's the critical number. So key question is, can we hit that number today? And our perspective is absolutely yes. When we look at any new build opportunity and simulate how we think a battery will trade, we're seeing revenues sufficient to deliver those IRRs. More importantly, on the assets that we're now operating, we've been consistently hitting in excess of those types of revenue levels. And actually since March, interestingly, with the COVID impact and the drop in power demand, that's actually led to frequent periods of low or negative prices, which has even increased the revenue that we've been able to achieve by some fair degree above that level. So that's why I think the main reason why the time for investing in battery storage has come. In addition, Capex continues to fall, and a number of other things are moving in favour of this being a very attractive investment. In the UK, just to say a little bit more about how this works, these are the three key merchant markets in which we operate. And really the trading strategy can be simply summarised that you're really looking to buy power at the lowest price that you can in any market that's available to you. And then you're looking to sell that power at the highest price that you can. Of course, that creates a spread over which you can then charge and discharge and make a profit. The other critical dimension, though, is how many times per day can you perform that activity. Getting an excellent spread, but only once a week, isn't any good. You'd rather have a smaller spread and hit it 2 or 3 times a day. It's the combination of those two things that leads to revenue. So what you ideally want is a market that offers frequent high and low prices and oscillates between them regularly. And you can see there, just from the little snapshot of some prices we pulled out from a particularly volatile period back in 2018, that the balancing mechanism is by far the best market for that opportunity. That said, though, day ahead and intraday provide very useful opportunities to take an early position to charge or to discharge. And actually, it's quite common that we would operate in all three of these markets, even for a single settlement period. It's not that you pick one market in one period and then stick with it. Quite the opposite, that you may take a position day ahead. You could unwind it in the intraday market. You could replace and unwind it again multiple times intraday, and then ultimately physically deliver physically in the balancing mechanism or through imbalance. On that, we can operate in either way in the balancing mechanism, either as a formal BM participant or through what's called NIV chasing in the UK, both really accessing fundamentally the same value, but through quite different routes. We believe at the moment NIV chasing is offering better revenue potential than formal participation, but that's very likely to change frequently over coming months and years, which is why we think having access to both opportunities is best. FFR and other ancillary services are a very valuable top-up to the revenue, particularly overnight where prices have been good, and that provides a good complementary revenue stream. You can't do FFR or other ancillary services simultaneously with merchant trading, but you can step in and out for different periods of the day or different days of the month. And that at the moment certainly looks attractive. However, when it comes to building the investment case, our strong view is best not to count on any reliance on ancillary service contracts long into the future. These markets are typically thin and prone to saturation, and we've seen that in the UK already to quite a severe degree. Prices go up and down, and when prices are good and you've got an operational battery, absolutely you take a contract, and that could be very lucrative. But before you've built and you're trying to get comfortable with the investment case, we believe the merchant revenue stack is the one to count on, because it's ultimately accessing deeper, more liquid markets that are less prone to saturation. And then once operational, ancillary services are an excellent potential source of upside. In Australia, just as an alternative case study, I don't know if many of you necessarily will have looked at this market, but it is very interesting in that it has a lot of volatility. It has 5-minute settlement periods, and in future likely to have 5-minute pricing as well. That fundamentally makes it very attractive to battery storage. And actually the revenues that we're seeing on offer today are significantly in excess of the level needed to hit those double-digit IRRs that I mentioned. There's a spot market which offers a good chunk of value, and then a whole suite of ancillary services which are called FCAS in Australia, many of which are ideally suited to battery storage, and they can be bid for simultaneously, and the system operator chooses some combination of FCAS and spot. Our simulation work suggests very attractive revenues there. The challenge, though, is a lot of these markets are local, they are quite thin, and therefore potentially prone to saturation. But nonetheless, even taking that into account, we think the Australian market is very interesting, and we've got a number of very substantial 200 megawatt projects and beyond that we're working on there at the moment. So that's the basics for the UK and Australia. Obviously, a lot of those principles, and indeed the ones that I'm going to go on to talk about, will apply in other markets like Europe and the US. But just to quickly touch on some of the questions that I get asked most often and to share a perspective. I won't have time to go into a huge amount of detail, but obviously happy to follow up if any of you are interested in these particular questions. So first of all, design questions. What duration of battery should I choose? Very fundamental, very important. It really can't be answered properly without the ability to simulate how a battery of various durations would operate, how it would degrade, what revenue it would generate, and so that you can build up a picture of the IRR and choose the appropriate battery. Having done that, this is roughly where we come out. Longer duration batteries, of course, cost more, but they also allow you to earn more per megawatt. Those two things largely cancel out, but there is a small difference. And at the moment in the UK, we're seeing 1.5 to 2 hour systems giving the highest IRR. That will, of course, depend on the particular Capex of the system that you're looking at, and it may well change over time. But certainly it seems like we've moved past the period where given prices and market volatility that 1 hour was optimal. It's now a longer duration. That also benefits in terms of the cycling intensity that you're likely to subject the battery to. It's much easier to strike a warranty agreement on a longer duration battery that you won't be cycling so hard. Second question, our view is, as you just saw, you will be likely to be cycling the battery at least 2 times per day, even on a longer duration system. will manufacturer warranties actually allow for that? It was true even a year or two ago that most warranties struggled to get beyond 1 cycle a day, but certainly our experience is now that 2 cycles a day or even up to 3 is completely achievable. It's not entirely straightforward. Typically, you will need to negotiate on various dimensions in order to get a warranty that covers the exact type of cycling that you want. One of the tricks to look out for, and we've come across this a number of times, is the headline warranty terms may allow the cycling that you want, but the fine print may actually be prohibitive and be problematic if, for example, there are temperature limits or cooling requirements, or you can do 3 cycles a day, but you need to rest for 1 hour in between each cycle. Any of these conditions you might have seen, and they can actually have a very material and detrimental effect on revenue, which is why we typically simulate the trading under a particular warranty and advise our clients on what impact they're going to have. Third question related to design: should I oversize cells? Should I, if I have a need for 100 megawatt hours, actually let the EPC sell me 120 megawatt hours, and that will give me, in one sense, less degradation for a period? Our view is no, that's not a good decision. Economically, it's not efficient to buy cells that sit around and do nothing. They will age just by virtue of even if you're not using them. If you're buying battery cells, the most economically logical thing to do is operate all of them right from the start, and then just live with the capacity fade as it happens. And similarly, should I take a deal where cells are topped up regularly, say once a year, as capacity fade happens? Our view is no, for a similar reason, but also you actually end up then with a battery after a couple of years, which is a hybrid of a whole bunch of different vintages of ages of cells. And from an operational perspective, that's a complete nightmare. Really, the way that you operate a battery should be a function of its age and its degradation, and you effectively end up with 4 or 5 or 6 or more different individual batteries on one site, all of which need to be optimized individually, and that's a bit of a mess and not worth it in our view. Moving to financial modeling, and just to hit on some of the questions again that we get asked most often. How long will the cells last, and how should I build that into my financial model? Well, the simplest answer, of course, is get a good warranty, and you can be confident then that even if the cells don't last that long, the risk is with the EPC. Our view is, though, that there's every likelihood that cells will last longer than they're warrantied for, and indeed that's a big focus of our operational approach, is to think about the degradation impacts of how we're cycling the battery, and we're aiming to get additional years of usable life beyond the warranty period. And of course, if you're pushing back the date at which you need to reinvest in new cells, that's significantly improving the IRRs. We believe you're likely to be able to operate down to 60% capacity relative to the initial nameplate, or possibly even lower. How quickly you move down that degradation curve as a function of the age through calendar aging, also the cycling, of course, but in a very non-linear way, and this is, I think, often underappreciated. You don't get a fixed number of cycles. The way that you operate the battery will significantly vary the cycling, the total number of cycles that you achieve with a set of cells. If you let the battery get hot, or you're going to extreme states of charge regularly, or your average state of charge is a long way different from 50%, that will mean you get significantly fewer cell cycle operational cycles out of the cells than if the opposite of those things is true. And that's why, again, this taking degradation into account through the optimization we think is so important. Will merchant revenue saturate over time is probably the question I get asked more than any other. It's very difficult to answer in a completely robust quantitative way with any tools. Fundamentally, any merchant investment is prone to saturation. Even coal and gas, if you build too much of it, yes, prices will move and revenue will decline, and that's the same for battery storage. The reassuring thing, we think, and certainly in a market like the UK, is most of the wholesale markets that we're operating in are sufficiently deep to absorb many gigawatts of battery storage. The balancing mechanism is less deep maybe than that, but at the same time is under increasing stress as more renewables come on to the system, and we believe it will take a number of gigawatts of battery storage before we see any material saturation, and that's an amount that's going to take some number of years to build. Can I get debt into merchant projects? this is again something where I think that the common view maybe it's difficult to borrow against merchant projects unless perhaps you have a revenue floor. But actually, our experience in working with some lenders is that it is possible to get debt into merchant projects up to about 45%, probably on an asset finance rather than project finance basis, is being offered in the UK at the moment. And we've worked with lenders on behalf of clients to help those transactions. And that, of course, can help the overall equity returns. Although that said, most of our clients are finding they tend to build and start operating all equity and then look to bring debt in later on as a more common approach. So that was a very speedy covering of some common questions. Just to finish, before we have time for one or two questions, really just to leave you with one message, which is we think co-location with solar is a tremendous opportunity for battery storage. It makes sense for a lot of reasons. I'll explain a couple of them. Basic idea, of course, that you share a grid connection point. You can be AC coupled or DC coupled. DC is preferable if it's possible. But there are a lot of complicated questions to be answered. How much solar capacity should I have relative to the grid? How much battery storage should I have? How will the battery trade? What's the investment returns? All of the same questions for battery storage, but then with additional variables, additional uncertainties brought in. Conceptually, the idea of co-location is that the battery can supplement and support the storage at minimum. So when it's sunny, if the solar is producing in excess of the amount of power that can be taken by the grid connection, then there's a chance for the storage to charge up using that excess solar generation that would otherwise be clipped. That's mode 1 on the left-hand side. Other modes are if it's moderately sunny, the battery may export direct to the grid, or it may export to the battery if it's preferable to do so. That's modes 2 and 3. And mode 4, and this is perhaps the most important, for the large proportion of the time that it's not sunny, the battery can operate very well as a standalone merchant asset. So long as it has a symmetric connection, it can charge and discharge and take advantage of that grid connection asset. And that's the beauty of this model, that you can operate in a number of different ways and make better use of the grid connection point. In terms of the numbers, whatever IRRs you're seeing for standalone storage, we think you can add something like 4 to 5% to the IRR by co-location. A lot of that comes from the value of sharing the grid, but you're also potentially sharing inverters, saving money on import if you're doing DC to DC. There's some opex savings and a relatively small amount of time that you would like to export with the battery, but can't because the solar is exporting already through the reconnection point. Adding that all up, we think very attractive IRRs in the sort of 16 to 20% range are possible depending on the site and the design. So that was all I was going to say. Do get in touch with me or anyone in the Habitat team if you'd like to hear more about what we do or any more detail on those questions. Andy, back to you.
Ben, thank you very much. It's a really interesting talk. And yeah, I mean, we had a couple of questions prepared to put to you based on the sort of subjects that you're going to go through. But as we're writing, I've come up with about 8 or 9. So I think we might have to schedule an interview after this so we can get through those in a more timely fashion. But yeah, really exciting to hear kind of, you know, obviously not only that the renewables integration piece is a bigger and bigger thing, and I'm assuming that kind of, you know, there's going to be some impact long term of growing net zero policies in the UK towards 2050 as well, or is it a little bit early to start modelling that kind of impact?
So our view is, well, you really don't even need to model to know that there's going to be significant increase in renewables over coming years. A lot of the particularly wind pipeline is already committed at this stage, and there's substantial, 100 megawatt and above merchant solar projects being developed all the time. That clearly is going to put more strain on the grid and put more volatility into particularly the balancing mechanism, and that's fundamentally an opportunity for battery storage to step in and help manage the intermittency and keep the energy system secure. Absolutely. And I think, especially in these days of COVID-19 and growing uncertainty, to see kind of, IRRs of 10 to 12% for standalone battery storage and rapidly going up, as you say, by about 4 or 5% with the co-location of solar is pretty exciting, I think. So yeah. It is. It's extremely exciting. I would just say also, though, difficult to fully sort of understand and model. And I'm really noticing too, the way the industry is sort of formed, it's like everyone's in either the solar camp or the battery camp. And they look at it from their own perspective, but there are relatively few players who have, I think, successfully managed to span both sides. And that's why the co-location opportunity, I think, remains to be captured by someone who can bring expertise and capability to both sides.
Cool. Okay. And yeah, I think briefly you touched on the move into the Australia markets that Habitat Energy is kind of is an ongoing piece at the moment, I guess. And I think you briefly touched on there being more risk, but potentially also more rewards in Australia. Do you want to just elaborate on that briefly for us, please?
Yeah, I think the reason it's attractive and why we're seeing such high revenue potential is largely down to the market design. That 5-minute settlement and soon to be 5-minute pricing means that you see a lot of volatility. And I mentioned right at the start how important it is that you're seeing regular swings of high and low prices across the day. Fundamentally, the more granular the market design is, the more likely that is to happen. The other benefit in the Australian market is that you can bid for spot trading and for ancillary services simultaneously, and let the system operator choose which services they actually most need, which is different from how it works in the UK. And also that gives you maybe double the revenue potential that we're seeing in the UK. The flip side, though, is those ancillary services at the FCAS is very locationally specific. And some of the markets could be as thin as 30 megawatts at certain times of the year or times of the day. So there is the risk if everyone goes and builds, 200 megawatts of battery storage that the FCAS starts to cool down and is a smaller part of the revenue stack. And so a big part of what we're doing now is trying to understand how far could those prices move and how much reliance can be put on spot as a deeper and more liquid market. And so far what you're seeing is that also offers a more than sufficient revenue and with lower risk.
Right, okay. And I mean, a lot of the excitement in Australia is both at residential scale as well as kind of the more grid scale stuff that you guys do. And I noticed that Habitat Energy is more about optimizing on the grid scale, kind of 50 megawatt upwards, I think is what you were saying is kind of the sweet spot. So yeah, just wondering if there's kind of a position you take on virtual power plants and, why you guys have opted to go for the larger scale versus an aggregation of lots of smaller assets, I suppose?
Yeah, we think both strategies are entirely valid. They're really just trying to do different things. If, for example, there were hundreds of very small residential batteries or C&I batteries, then yeah, absolutely. If someone can work out a way to efficiently contract those, communicate with them and manage them, and literally aggregate them into a bigger block of capacity, there's value with that approach, and it will certainly benefit the system. Our strategy has simply just been different from that, which is to say, well, look, if you've got a 50 megawatt asset, that's a very sizable chunk of capacity in its own right. It needs to be optimized entirely in a bespoke way, specific to that battery, to that location, to that warranty, to that owner risk profile. We can't just bundle it up with a bunch of other stuff and do, turn it all on and all off at the same time. Also, because it's a big asset, it's got one owner, it's going to have very high requirements in terms of transparency and risk management, and that just becomes a very bespoke service, which is just the end of the market that we've preferred to focus on. But I think the industry absolutely needs both.
Sure. And I think it's a final question to finish on, as we're just about to reach our allotted time, I think, is that, obviously you talked a lot about the market opportunities that exist. And yeah, there's plenty more I'd love to ask you about those maybe when we go offline. But yeah, just as a final opportunity for you to kind of wax lyrical about Habitat, I guess. What is it about you guys and your software and your algorithmic trading that you'd say would sort of differentiate yourselves possibly from others in the market?
Well, as I said, we set out with battery storage in mind, and I think that has made a difference to the tools that we've built and invested in and the capabilities. A lot of potential operators out there and owners of battery storage own other assets and maybe have come at it with a more traditional trading sense and then got to the algorithmic approach later. We've focused on that from the start, and I think coupled maybe too with the very strong focus on degradation management and understanding the physical battery asset, which we've been able to do through a relationship with Oxford University's battery lab. That's been a big part of it. Maybe as well, to be quite frank, it's just we've been doing this for a lot of years now, and it just takes time to get up the curve and get on top of all of these challenges. It is very complex, as I said. It's taken us a lot of months to understand all of the hidden complexities, and now that we're operational, as I said earlier, we're really genuinely delighted with the revenues that we've been able to achieve, and we're keen to communicate that as widely as possible and let the world know battery storage is investable today.
Brilliant. Okay, Ben, I think that just about wraps us up for today. As everyone can see, Ben's email address is on there, so we're sorry that we didn't have the chance to ask questions from the audience, but certainly I presume, Ben, you'd welcome any approaches from interested parties, and I'm sure there's plenty to discuss there.
Absolutely. Thanks, Andy.
Cool. Thank you very much.